Good morning, everyone. Welcome to this update for global stocks and commodities for the 8th of October. We finished with the strongest week of the year on the S&P 500, which is really not what we would have expected coming into this year, given the bit of a wobble around the end of last year and being October. But we've had an extremely strong quarter through July and August and September. And we've burst into October with a really strong week. So everything is still looking extremely positive. Let's have a look at what is in this update. I wanted to look at how to play this roaring market. Is this just speculation? Is this some sort of blow off top, or is this rally really justified? If you've been following these weekend videos, I think you probably know what my stance will be. But anyway, let's examine that point. I want to look at what sectors are leading this market higher, because clearly I've been talking about a sector rotation now for quite some time. That's natural and normal as money rotates through different sectors. So let's have a look at what sectors are doing best, and also what small caps are doing at the moment, because that's pretty revealing. So let's start with the American stocks first of all. The S&P put on 30 points for the week, and that's a pretty big week on the S&P, and is the strongest gain that we've had since December of last year. The odds favour this rally continuing for a whole lot of reasons, but mainly because it's supported by real-world fundamentals. This is not about speculation. It just isn't. The US ISM manufacturing index is the highest in 13 years, and the non-manufacturing index is the highest in 12 years. So this is a pretty buoyant manufacturing sector in the US, and that's one of the reasons why the US small caps are doing so well. But also, if you look around the rest of the world, whether it's Japan or China or Europe, pretty much wherever you look, the purchasing managers indexes are also setting short-term records, and they're moving higher. So that's why I say that this is really being supported by real-world fundamentals. The valuations are fairly full, but they're not extreme. And there are some pockets of real value. Stocks that are growing at 20-25% per annum on their profit, and they're trading on PE ratios of between 10 and 13, 10 and 14. That's pretty good value in my view. So there's absolutely no reason why this rally can't continue, because it's being underpinned by the sorts of things that you want to see. Has this sector rotation that we're seeing, is this the kind of a rolling correction that we're getting? The fact that, one sector like technology had been leading for several years. Technology's had a little bit of a sell-off in the middle of the year, starting to pick up again now, but has obviously had its minor retracement. So is this successive sector rotation, is this the correction for the whole market? So the whole market is not doing it in step, as sometimes happens, but the correction is happening sector by sector, and therefore the overall market indices can continue to advance. I think that's very likely, and if you accept that premise, then simply roll with the rotation, follow the money. Don't stress about whether the market is going to reach some sort of high and roll over. Just go with the sectors that are showing the strength at the moment. And I want to examine what sectors those are over the last 30 days. Now, as we'll see on the chart, the US dollar, which had been falling all year, is now back into a rally phase. It's not out of the woods, but it's certainly showing some strength. And the way some things are unfolding in Washington, I think that's more supportive of the US dollar than detracting from it. So I'll just touch briefly on these sector leaders, and then we'll go and look at some charts. So over the last month, the financials sector as a whole, which obviously contains many industry groups, something like 20 industry groups, but as a whole, that sector is up nearly 9%. the leading industry groups within the financial sector are investment services, banks, insurance companies. So that's a sign of a pretty healthy market. The next best performing sector has been the industrial sector. It's been up 6.5% in the last 30 days. And the leading industry groups within that sector are airlines, clearly. But I just have this mental block about investing in airlines. I think it's a good way to rip up a lot of money. Commercial vehicles have done really well, so that's reflective of higher levels of transportation of goods, which is indicating a healthy economy. Machinery sales are up, so those manufacturers are doing well. Aerospace has done well, and also heavy construction as an industry group has also done well in the last 30 days. So they're the keys, and this is indicative of the late part of the business cycle. The fact that industrials and, as we'll see, materials are joining in. Energy, of course, is another beneficiary generally of the late part of the cycle. And when I'm talking the cycle, this is big picture stuff. This is decade long kind of business cycle. So all these sectors that are doing well is fairly normal and expected for the latter part of the cycle. The best industry groups, coal was up by a massive 15% in the month, so a huge spurt in coal. Exploration and production companies, but also energy service companies, so the drillers and all of the peripheral services that service that industry. And also materials have done really well, also up 6%. And drilling down into the industry groups, commodity chemicals have done best, and that's just a classic late cycle industry group to be doing well. Specialty chemicals and also packaging, which packaging ties in with the trucking and commercial vehicle sales. So everything is kind of really tying in and coming together very nicely. Let's have a look at some charts. So we'll start with this relative comparison chart, and it's looking at three parts of the US market. The red line is the Dow Jones Industrial, which is obviously the top 30 stocks by, it's not by market cap, it's actually by price, which I think is a very spurious indicator. So I think the Dow Jones is a pretty irrelevant indicator personally. The second one is IWM, which is the Russell 2000, the ETF that covers the Russell 2000 in blue. So that's the small cap end of the market. And then the green line is the S&P 500, which is obviously the broadest based index of the lot, but is a market capitalization index and is dominated by a lot of large stocks. So that's what it looks like over the last 12 months, coming off a common starting point. So if we adjusted them all to be starting at the same point, then the Dow Jones has done better than the small caps, than the S&P. But you can see that the blue line has absolutely rocketed up in the last little period. So let's just zoom in on that to see what's actually been happening over the last 3 months. So we'll look at the last quarter. So there clearly you can see the blue line, the Russell 2000 small caps, is just absolutely outperforming the larger sections of the market. And that's one of the things that really reinforces for me the fact that this rally is sustainable, the fact that small caps are actually accelerating. That's a really, really positive sign. And let's just go in just a little bit tighter, and we'll go in and look at this on a common basis over the last month. And you can see that the Russell 2000 is just absolutely smashing the rest. So huge strength in the small cap area of the market over the last 30 days. And that to me is one of the best signs that this rally is very sustainable. Let's turn now to the S&P itself, and that's the S&P on a daily chart. So you can see we've had a pretty good week and also a pretty good 2 weeks. But let's just pop this on a weekly basis, and you can see that this positive candle here is bigger than anything that we've seen. You've got to go back here to the first week of December 2016 to get a larger week. Finished right on the highs, so it's all extremely positive. Now, I'm not saying there won't be some small little pullbacks. Here was a pullback that occurred in March of this year, and we dropped from just under 2,400 and we hit a low of 23.29, so a drop of about 70 points. So those sort of things are always possible and always quite likely, but the trend is unquestionably strong and it's unquestionably up. Let's just look at the Nasdaq, because that is also looking extremely positive. Was underperforming the S&P for a little while, and has not really changed its trend at all. It's slowed down. So the Nasdaq relative to the S&P did slow down, but you can see it's picked up again quite nicely in the last little bit. So that one's done extremely well. The US dollar is the US dollar index. So let's take a bigger view of this. So we didn't quite make it to this declining trend line, which is part of this overall megaphone pattern that we've seen starting to develop over the last 2 and a bit years. So the highs are getting higher and the lows are getting lower, but we've had a nice little rally and probably got more signs of continuing than other. Moving on now to Aussie stocks. The Australian dollar was down as a result of the US dollar strength, so down under 78, which is a nice change. And it was a combination of the stronger US dollar, but also some pretty poor retail sales in Australia, and unexpectedly poor retail sales have put the RBA on hold indefinitely as far as raising interest rates. And it's not out of the question that if things keep deteriorating as they are, that a rate cut is a possibility at some stage in 2018. But for those of you with mortgages, I think you can probably breathe easy for a while. Certainly not in the next 12 months. I don't think there's much chance of a rate increase. Now the ASX 200 was up by 30 points on the week. It was down before that, but it was saved on Friday by a pretty good move in the banks, which is consistent with what we're seeing around the world. And as with America, the XSO, which is the Australian Small Cap Index, is clearly the outperforming index. It's chalk and cheese between that and the rest of the market. So small caps, and I've been saying this for a long time now, if you want to play in the Australian market and get an above average return, there is just only one place to be, and that's small cap stocks. But you've got to be very well researched, and you've got to be very targeted and very patient to take advantage of those opportunities in the Australian market. So let's just take a quick look at that index. So there's the Aussie market. Nice move up on Friday, which really got us back into positive territory. But we just continue to be stuck in this tight little range, just above 5,600 points. There's a little bit of a downward bias to it. You notice that the highs are getting slightly lower all the time, so a little bit of a downward bias. So if I had to pick a direction, I think I would be picking the breakdown in the ASX 200. But that doesn't mean that there can't be some good performing small caps, because there certainly are. Moving on now to precious metals. Gold was down by $5, down to $12.75. It did actually get a bit lower than that, but bounced on Friday. And we've seen a retest of some key technical levels, both on a shorter term and longer term basis. So we'll take a look at those. The holdings in the GLD ETF dropped slightly, but we're still holding up pretty well considering how far gold has come off. It's come off nearly $100 an ounce, and yet the ETF holdings have been pretty steady. Precious metal stocks still doing nothing, but as we'll see, a bit of a small uptrend of late. So let's take a look first of all at gold on a daily basis. So you can see we had a possible support level here coming in around 1266, and indeed that provided some support, and we got a bit of a bounce, bit of a turnaround on Friday. Let's look on a weekly chart. So we've got this big declining trend line since the 2011 peak. We managed to break above it in August, rallied up to these previous highs from 2016, and now we're coming back down again, and we're retesting that declining trend line. Now this is a pattern that's not uncommon, so I wouldn't be at all surprised to see some near-term support coming in for gold. But it's still not showing me anything yet that indicates that we might see something sustainable. And if you look at GDX, this is a weekly chart also. You can see we've been in this zone here now since really all year. We've pretty much been in this zone between 2050 and 2550. Now you can see that there is a bit of an uptrend. We are forming higher lows, but it's not really showing any signs of anything sustainable at the moment. We really need to break above these highs, so we need to see GDX above 26 to show that there's a change of character occurring in the gold market. Other commodities, copper drifted up slightly to 299. Crude oil slipped. That was really with the US dollar rally. Slipped back under $50. The oil stocks are overbought. They need a pullback. But as I indicated last week, they're certainly looking a lot more positive now. And I think there's definitely some green lights for the sector. But as we will see when we take a look at XLE, so this is the energy sector ETF in America. You can see we've now broken out, we've formed a higher high, and there's really been no retracement since this started back in mid-August. So if we were to get a little bit of a pullback, perhaps a retest of this breakout somewhere around the 66, 67 mark, then I think that might prove to be an opportune entry point into the energy sector. There's the spot copper chart, just worked its way a little bit higher. So just to bring it all together, I get lots of emails from people and discussions with members, and it's normal for anyone to get a bit apprehensive when markets have gone up as far as they have. But I'd really encourage you, don't be deterred by how far the stocks have come. Just look at where they could be going. And if you look at all of the signs that I've shown you throughout this video, the fact that we're getting small caps doing as well as they are, the fact that we're getting globalized, synchronized growth, we're getting purchasing manufacturers indices that are moving higher, and the fact that we're getting leadership from the sectors at this part of the business cycle that we would expect to see. There's just nothing really untoward going on in this market. So I'd really encourage you to focus on where stocks are likely going. We've still got easy central bank policy. Yes, we are now in a tightening mode after nearly a decade of easing, but it's still going to be pretty easy policy for some time because of all the debt. Trust the strength and look, keep an open mind on all things. One of the real dangers in the market is that you have a preconceived idea or opinion, and you can't see the wood for the trees. So keep an open mind, trust the strength that's in the market, and it should be a pretty good run into the end of the year. Portfolio analysts this week, and of course there are still a 2-week trial period is still available for those that are interested. I'll be doing a review of breakouts and how to play breakouts, how to enter, because there's multiple opportunities to enter into a breakout as it's building. but also after it's been confirmed. I'll be looking at biotech stocks, and I'll be also looking at material stocks, which are clearly leading the market higher. So that I think there's some terrific opportunities in the materials sector of the market. So that's it for this week. There's my contact details, and I'll be back with you next weekend. Cheers.